And homebuilder sentiment still negative, even though it inched higher this month. But National Economic Council Director Kevin Hassett said the Trump administration will share plans for affordable housing in the new year. So could the housing market recover next year, or will that weakness continue? Joining us now is Alan Ratner from Zelman, a Walker and Dunlop company. Okay, so we had this conversation with Kevin Hassett earlier, and I was kind of probing him on what types of options they're really looking into. He declined to answer, said that all that information will come out later. But if you were advising this administration, if you were discussing the options that were most viable here to improve housing affordability, what would they be?
Good afternoon, Leslie. Thanks for having me. It's really a complicated issue. There's a lot of attention being spent here, and thankfully, from what we hear, the conversations between the administration and the industry are collaborative. They're being productive, and we're hopeful that something can come out from these discussions that can move the needle. But the real challenge that we've seen is, the real bottlenecks, the real inflation is occurring on the local municipality level, whether it's related to impact fees, delays in approvals and development timelines. And, unless the federal government, gets a little bit more comfortable wading into local politics, we think that anything done, on the margin might be beneficial, but it's hard to really make a huge dent without the local involvement.
Well, one thing that is done at the federal level, at the Federal Reserve, that is controlling interest rates. Do you see any type of unlock that could come from a more dovish positioning going into 2026?
Well, it is complicated because the Fed controls the short end of the curve, and the 30-year mortgage rate is really priced off of the 10-year Treasury yield, which, that's a function of a lot of things, including inflation expectations, the deficit, and what we've seen up to this point, even though the Fed has cut several times here, is that we haven't necessarily seen a commensurate move in the 30-year mortgage rate. So there's things that can be done to improve rates, whether that's looking at LLPAs, loan level pricing adjustments, having potentially the Fed continue to buy MBS to tighten that spread versus treasuries. And we think all of that is on the table, and it's in many cases already occurring. But I'm not sure that anybody hoping for a huge reduction in mortgage rates is likely. That's unlikely to come to fruition in 26.
Right. What about tariffs? Just kind of brainstorming all the different possibilities here. How have tariffs played a role in lumber prices and just the cost of materials to construct homes? How is that impacting supply? And if there were some sort of reversal on tariffs, would that make a dent?
Yeah, that's probably one of the good news, pieces of good news that we've seen this year. There was a lot of concern that incremental tariffs would raise the cost of producing homes anywhere between $5,000 and $10,000 per door. That's what a lot of the builders communicated to investors earlier this year. And what we've actually seen is at least the large public builders have been able to use their size, use their scale to actually push back on the trades, push back on the manufacturers and suppliers, and really keep those tariffs downstream. So we haven't seen that flow down to the home builder, and we really haven't seen it flow to the consumer. If anything, new home prices have been on the decline this year when you include the benefit of incentives like mortgage rate buy down. So I'm not sure reversing tariffs would necessarily be a benefit for the consumer. It might be a benefit for the suppliers and the manufacturers that have eaten those added costs this year.